Welcome back to week 6. We're continuing in unit 6, which is the banking unit. So if you would please join me in Google Classroom on the classwork tab, we're going to go down to the banking unit and we're going to open up the vocabulary document. Now on Friday, you were to have done the banking Kahoot, a blind Kahoot. I did not expect you to know and understand the terms. Today we're going to go through the terms and define each of the terms. So you're going to need to make a copy of this. All right, so in the blind Kahoot, you would have been presented with the definition to turn a debtor's belongings into cash in order to pay creditors. Do you remember what that term was? Called liquidate. When you liquidate something, you basically are turning it into cash. So I might liquidate a car by selling it, just for instance. What do we call the property pledged to protect a lender if the borrower fails to repay? So I've taken out a loan and I've told the bank that if I don't pay my loan payments, if I don't pay back my monthly loan payments, they could take my car. So what do we call my car in this case? Well, that would be collateral. They can take my car. I'm putting my car up as collateral. So if I don't pay each of my monthly payments to the bank, they can take my car. That's my collateral. If they were to take back that car, my goods, so to take back goods by the secured party, that would be the bank. If the debtor, that would be me, does not pay back the loan, what do we call this? So in this case, what's the bank going to do with my car? They're going to repossess it. A party who buys goods on credit or who borrows money. What do we call those people? Those would be debtors. Let me slide this up a little bit. All right, a sum of money kept or placed in a bank account. What do we call this? Well, we call this a deposit. So when you put money into your bank account, it's called making a deposit. When you have money in your bank account, those are your monies on deposit, your amount on deposit. All right, money owed or deducted from your account. So every time, like you write a check and the person cashes that check, it is called, or every time you go to an ATM and you pull out money, it is known as a debit. That's why they call it a debit card, because you're basically taking cash out of your account. Debit. All right, an action of conducting business. So we're in the banking unit. Any action in conducting business with the bank is called what? That's called a transaction. So whether I'm putting money into the bank or I'm taking money out of the bank, it is still a transaction. A deficit in a bank account caused by drawing more money than the account holds. So if I have $50 in the bank, but I either at the ATM try to take out $100 or I write a check for $100, and obviously there's not enough money, there's only $50 in the account. What is this known as? This is known as an overdraft. Now understand that if I write you a check for $100, but I only have $50 in my account, yes, I have an overdraft. There is not enough money in my account to support that check that I have written to you. My bank, once you deposit that check into your account, my bank is going to charge me $50 for having written a check that my account could not support. Your bank might also charge you $25 to $50 for trying to deposit a check that did not have enough money in their account to support it. Now, the problem with this is, how are you supposed to know how much money I have in my account? And should you really be held liable because I don't have enough money in my account? So that's kind of a sticky wicket, but it is what it is. So the next term is NFS. Do you remember what NSF stands for? Non-sufficient funds. So a check could be an overdraft or it could be marked as an NSF. So non-sufficient funds, it's Also, a check that bounces is known as an NSF. So NSF, non-sufficient funds, a check that bounces. If you think about a rubber ball, it bounces down the road. A check that does not have enough money in the account to support it will bounce, just like a rubber ball. It's a rubber check. That's why they say that it bounces. So an overdraft, an NSF, a rubber check, a check that bounces, it all refers to this same thing when there is not enough money in the account to support a check or a draft made on that account. All right, a CD. CD is not a compact disc. It's a certificate of deposit. It is similar to a savings account, but it's virtually risk-free. However, it differs from a savings account because it has specific fixed terms. Oftentimes, these terms are 1, 3, or 6 months, or 1 to 5 years. And they usually have a fixed interest rate. The customer holds the CD until maturity, at which time they can withdraw the money and the accrued interest. CDs are usually higher interest rates than savings account. And accessing money prior to the end of the time period results in paying a penalty. All right, so accrued, not accrued, accrued. Okay, so that's a CD, certificate of deposit. All right, there's a math term or math equation that you must learn, which is P times R times T equals I, where the P stands for principal, R stands for rate, T stands for time, and I, interest. Okay, so principal times rate times time gives you your interest. So it could be, so the principal, how much you're borrowing, the rate, what percentage rate that you are borrowing at, and time is the length of the loan, gives you how much interest. Interest is defined as money paid regularly at a particular rate for the use of money lent. Traveler's checks, while they still exist, aren't used as much, but you still need to know what the heck a traveler's check is. But basically, traveler's check is as good as cash, but you're just not walking around with cash on you. They're kind of a cross between a check and cash, but think of them as cash. But they hail from a time when ATMs were non-existent. I know that this is like unbelievable for you, that there was a time when ATMs were non-existent, but they didn't always exist. So back when you couldn't just go down to the corner bank and at 11 o'clock at night and pull out money. It used to be when I was growing up, my mother had to go to the bank. If we were going on vacation, my mother would have to go to the bank like Friday morning because banks were only open from noon until 12 and then from 12 until 2, and then banks were closed. So after 2 or after 3 o'clock, you could not get any money. So a lot of times people would have to rush to the banks and stand in line or sit in their cars standing in line to get to the tellers so that they could have money for the weekend. And you would have to take out cash and walk around with a wad of cash if you were going on vacation because your bank wasn't necessarily wherever it was that you were going to go vacationing to. So basically, you go to your bank and get checks issued for a predetermined monetary amount Okay, so again, basically you go to your bank and get checks issued for predetermined monetary amount that you can then technically exchange anywhere for cash. And it's good at most places around the world, so that you could be traveling in Europe. You could go to, I don't know, Egypt and go ride the camels, and they would have taken traveler's checks. The most popular of the time were American Express traveler's checks. So safe deposit box, where would you find a safe deposit box? Do you keep a safe deposit box at your house? No. And what would you keep in a safe deposit box? Well, the safe deposit boxes are typically located in a bank. So what do you keep in them? Well, you keep important documents like your car title, your deed to the house, your will, your marriage certificate, birth certificates, photos of personal property. You keep them safe by storing them here. And typically, these safe deposit boxes are located in the bank's safe. So when I go to my safe deposit box, I go into the bank and I tell them I want to get my safe deposit box. They bring me out a signature card and I have to sign my signature card. I have to show them my ID and I present them with the signature card. And if the signature card does not match the signature on file, they don't let me in. So once they match it up and they verify I am who I say I am and I have all legal rights to access my safe deposit box, I then am supposed to have a key with me. So they let me into the bank safe and they close the door behind you and you present them with your key and they have a key. And literally these boxes have 2 keyholes and they turn both keys and it opens the outer door and then they pull out literally a drawer. Mine was about 4 inches wide by about, I'll say 2 inches high by about 2 feet long. You can get them bigger, you can get them a little bit smaller, but I typically just needed to keep family jewelry and like my marriage certificate, birth certificates, and my car titles in there. Now, the reason you keep your important papers there instead of at your house, because if you have a house fire or a flood at your house, those documents are then gone. Typically, banks do not catch on fire. And when there are like tornadoes or bad floods or things, typically banks are some of the buildings that somehow survive these natural disasters. But you keep these things safe in there. And like I said, it's in the safe, in the bank. The safe gets locked every night, so nobody's going to hopefully break in. And when the bank is open, nobody's going to break in unless they somehow can forge your signature and have an ID that has your name on it and yada, yada, yada. So they're very safe and get very good place to keep your important papers. Now, there are 2 kinds of loans. One is a secured loan and one is an unsecured loan. So what the heck is the difference? So a secured loan is a loan in which the borrower pledges some asset. For example, a car or some sort of property. And they pledge this as collateral for the loan. This collateral then becomes what is called a secured debt owed to the creditor who gives the loan. Typically, the creditor in this case would be the bank. Let's see, some examples of secured loans would be your mortgage, your home equity, line of credit. Some people call these HELOCs. If you ever hear somebody calling something a HELOC, it's a home equity line of credit. An auto loan for either new and used cars, maybe a boat loan. So those are secured. They are secured by collateral or through collateral, with collateral. So earlier when I was talking about using my car as collateral for a loan from a bank, it would have been a secured loan. An unsecured loan is a loan in which nothing is used as collateral. For the loan, lenders take more of a risk, resulting in considerably higher interest rates. Examples can include credit cards, personal loans, otherwise known as signature loans, personal lines of credit, student loans, and some home improvement loans. Here's a side note though. Tax returns can be garnished to pay delinquent student loans. So what the heck does it mean to garnish? If I'm getting child support money from my ex-husband for my children, and my ex does not pay 1 week or 1 month, in New Jersey, they would garnish his wages, meaning that his employer by law would be told that they have to pull out the amount that is owed to me from my ex's paycheck. So I would get my money so that I can clothe and whatever the kids, and he would get whatever was left over. So if he was getting paid, we'll say $1,000 a week, but he owed me $500, he would only see $500 of his check because the state would have garnished his wages and sent that extra $500 to me. Now, if he owed me $800, they would garnish that $800 out of the $1,000 so that he would only end up with $200. So when we're saying here, your tax returns can be garnished to repay delinquent student loans. If you have delinquent loans, and let's say you're expecting $3,000 in your tax returns, but you owe $5,000, you will not get any kind of tax return because those tax return monies will be going right over to pay off your student loans, as well as show up as a ding on your credit report. So don't think that, oh, well, that's how I'll pay my student loans. And you'll still end up owing money. If you owed $2,000 and got a $4,000 tax return, they would take out the $2,000. They would garnish that $2,000, and so you would only get a check from the IRS for the extra $2,000 that was left over of your tax return. So garnishing is not a good thing if you are the one who the money is being garnished from. All right, so those are unsecured loans. APR, do you remember what APR stands for? Annual percentage rate. And a money market account, basically this requires a set balance in order to open. Basically, there's a set balance that you must have on deposit when you open up a money market account. So, got to have that. So I've got some links down here that talk about interest. What the heck is compound monthly versus compounding annually? As far as simple interest, there's a good Khan Academy video that explains what simple interest is here, and an explanation for compound interest, again from Khan Academy, is here. They're both introductory, so they don't get real deep into all of into what the heck these kinds of interest are, but they will give you a good overview, a good first level understanding of what simple versus compound interest is. So that's your vocabulary. Next video you need to watch is the open outline.